taking time out to join us on this webinar of the Nigerian Quantity Surveyors Qatar. The title of our topic for today is Practical Cost Reporting and Earned Value Analysis. I'm sure most of us that are involved in construction one way or the other, we know that as quantity surveyors, as engineers, there are reports that are prepared at different time intervals, weekly, monthly, quarterly. And this report, especially the one that has to do with cost report, have specific requirements that they must meet to help those that are going to take decisions to understand and take information from the cost report that we prepare or that we analyze or that we use. But more than just what happens to decision makers, we understand that there's additional importance in the cost report that we prepare for cases or things that might happen in future on the project, such things as claims or such things as dispute, even going to arbitration or even litigation. These cost reports are very important sources of information that can help. And that's why today we have gotten one of us to help us analyze and give us practical application on cost reporting so that we can use the knowledge that you gain here today to help us in our daily work, and most importantly, to make us better quantity surveyors and cost engineers, as the case may be. So I will talk about our presenter. Our presenter is Victor Ayegba. He works with KEO International Consultants. He has over 20 years experience in quantity surveying, construction, and related materials, and related sector, both in the public and the private sector of the construction industry. He's worked in Nigeria, he's worked in Seychelles, and he's worked in the Middle East, generally Qatar to be precise. Victor holds an MBA from the Metropolitan School of Business and Management, UK, and has a Bachelor Degree in Quantity Surveying. He's a Chartered Quantity Surveyor. He has the MRICS status. He's also a professional quantity surveyor with the Canadian Institute of Quantity Surveyor. He has a FQS certificate. He is a member of SAVE International USA. And Victor is a fellow of the Quantity Surveyors International. In addition to being a fellow of the Quantity Surveyors International, he's also the vice president of Quantity Surveyors International. Victor is the minister of God with Redeemed Christian Church of God here in Qatar, and is happily married with children. We can see from the introduction of our presenter is vast in experience and knowledge, and we are glad to have him in our midst. We are glad to have him at this time to present to us. So I welcome Victor, and right now, Victor, the floor is yours. You can start. Thank you very much.
Good evening, everyone, once again. Just like I've been introduced, my name is Victor Ayegba, and I'll just go straight to the presentation. So we're talking about cost reports and earned value analysis or earned value management today. And the first thing that we have here is the principles, purpose, models, and others, principles of cost reporting. So I will just start that, cost reporting is just for us to give the client, an update on what is happening on the project commercially. So basically, in preparing the cost report, what we are supposed to do is to make sure that the cost report is as simple as possible for everyone to understand. Our cost report should be as simple as possible that, the high-level managers, the clients themselves, they can understand what we are reporting. Another item I have here is we should be able to compare the latest forecast view of out-turn costs with the previously approved budget. Out-turn costs, has to do with, the contract sum of the project and with all the variations, the fluctuations, all the additions that we have, added to the contract sum is the outturn cost of the project. Some people call it forecast final cost. So, or forecast contract final account. So, another item we have on the principles of cost reporting is that our forecast outturn costs should include the base estimate plus the risk allowance. It should include the base estimate, that is the contract sum that we have, plus all the risk allowances that we have on the project. Our cost report should have a change log. It should have all the changes that you have. Is it the site instructions or the anticipated costs? You should have everything included in it. You should be able to identify the future changes in the project, all the future changes. Cost report is a report that, tells the client, commercially, where you are coming from, where you are at this point, and where you are going commercially. It should include updated risk register. It should include potential claims, claims that could come from the contractor, claims that, expenses that the contractor will experience on the project, and maybe those that they have given notices. So all the cost reports must include all these costs. Then it should also include comments or references to key areas of expenditure made after the previous report. We'll talk about the frequency of the cost reports anyway, but then at any point you are sending an updated cost report for the month or for the quarter, you should give a reference, a comment, what has changed between the last cost report and the current one that you are preparing. Then if you go ahead, we're going ahead, is that cost report should also show overspend. The QS should be able to comment on the steps taken and being taken to make it align with the budget, that was set from the beginning in the project. So our cost report should have a forecast payment profile. Should be able to have a profile of all the costs in the project, payments that are made, how much have you paid, previously. You have to give a log of the payment. Number one is the advance payment. Then you go to the second payment, interim payment, and all the payments up to date. Your cost report must have a schedule, must have a payment log, that has all this in place. Then I move on to the purpose of cost reports. Why should we, prepare and submit cost reports? All cost report based on your particular contract condition. The first item I have is that it must have a known cost that is known to date, and it should have an accurately valued cost to date. That is the first one I have here. That is the purpose of cost report. That is number one, known to date and plus accurately valued. That is, known to date means that, you have the contract sum, which you already know that this is the cost, part of the cost for the project. Then there are some variations that have already been valued, that have been agreed. You have a variation order already. So these are known costs. So then you have to accurately value, this cost. You should be able to accurately value costs that you have all the information about. You have the prices, you have everything that you need to estimate or to calculate a particular variation or the other. The second one is the known plus the estimated. All the known, all the ones that you have accurately valued, plus the estimated, the ones that you can accurately estimate to say, okay, at the end of the day, it can be 1.9 million, it can be 2 million, and all that. So this also has to be part of the cost report. Then the third item I have is the final focus cost that is foreseen to date. You look at, in the future, there are some expenses that are expected. You have, how do you call it? You have some claims that the contractor has submitted notices, and you discover that these notices are valid. So you are expecting that the contractor, at the end of the day, is going to submit the cost of these claims. So what you are supposed to do is to estimate these focus costs and include it in your cost report accordingly. Then the last one I have is the risk allowances foreseen to date. There are so many risks on the project. Sometimes you will be excavating, you discover you see some cavity in the ground. So this cavity, how are you going to deal with it? Maybe it's a very big cavity that needs to be filled up. Are you going to fill that cavity with concrete? Are you going to fill with just backfill materials and all that? So all these, are the reason why we have to prepare cost report. Then the model, what is the model of cost report? We have various type of contracts. In these various type of contracts, we have different way in which we handle the variations. Apart from the contract sum, we have different ways that we deal with the variations based on the type of contract that we have. So the model of our cost report should follow the type of contract that that is part of your project. If your contract is a lump sum contract, the way you present your cost reports is different, because lump sum contracts, remeasurable contracts, I think the major difference that we have is that, in a remeasurable contract, you are expecting remeasurable items that needs to be valued. If the items you have in the contract, the actual quantities that you have is more than what you have in the existing contract, you need to value that. But in a lump sum contract, that does not happen. Other than that, every other thing, the fixed cost, the variable cost, the variations, the loss and expense, fluctuation, risk allowances, all these are the same for lump sum contract and remeasurable contract. Then we have the reimbursable contract, we have the management contract, we have the construction management contract. All these, the way the cost report is being prepared for all these contracts are different. The management contract, we're talking of management fee, we're talking about adjustment to management fee. In the construction management contract, we have all those fees also to be adjusted. So what are the factors that affect out-turn costs, that we have to report in our cost report? The first item that we have to report is the fixed cost. Fixed costs. Fixed cost is this cost that has already been agreed, which we call it the contract sum. It's already been agreed. So this is the first item we ought to report in our cost report. Then, in addition to that, what we need to report is the variable cost. Variable cost. So the variable cost includes the provisional sums. We are all familiar with all this. All what I'm talking about for us, in the industry for years, we are very much familiar with this. But so those that are coming up on this call, is an additional knowledge for us. So the variable cost includes the provisional sum, the provisional quantity, the prime cost sum, the day work allowances that we have on the contract. So these are the variable costs. So we know how to adjust our provisional sum. If you have a provisional sum in the contract, you have to adjust it, the ones that you have been given instruction to adjust, because you have provisional sum in the contract. What you're supposed to do is to, if the contract wants to activate it, it has to be activated. Then every other process will come up. Then same to the provisional quantities that we have. Some quantities have been allowed in the contract, or when the actual quantities are known, so the contract needs to be adjusted as well. So all this will have a table to be part of your cost reports. So we have the prime cost sum, prime cost sums. These are items that the rates are included in the contract, and the rates will have to be adjusted to the price of the materials. The specifications are not confirmed. Maybe you have a WC, you don't know which type of WC you have to use at that particular point in time that the contractor is pricing. You don't know the specification. So there is an amount allowed as a rate in the contract, in the BOQ. So as soon as this is known, the specification is confirmed, there will be an adjustment to do for the prime cost sum. And this also will be reflected in the cost report. So we have the day work allowances for items that require day work. We know the process of getting the work, done on the projects. Then the other item we have is the variations. Variations, as you know, they are contract instructions issued by the client for changes that are deemed necessary in the contract. So these variations also will have to be reported. If you have site instructions, if you have issued site instructions, you have variation order, issued site instructions, you have anticipated instructions, instructions that are, you have early warning, you have information, but this has not been translated to cost. It's the duty of the quantity surveyor to, analyze all these costs and, attach costs to them and prepare them, include them in the cost report as well. Then we have loss and expense. Loss and expense, this has to do with, claims that comes from the contractor. Then we have the fluctuations, where your contract has fluctuation clause, and we have risk allowances. So all these combined are the factors that affect the outturn cost of the project. So in terms of the format of cost reporting, there is no specific format. If you look at the RICS, the Guardian's notes, the first edition, is clearly stated that there is no format, no agreed format, that the cost report must follow. So if you're on a project, I'm on a different project, and we're doing cost reporting, our formats can be different, but the principles are the same. The principle, to apply to cost report are the same. So the other item that I have is that what is the reporting frequency of cost report? How often are we supposed to report, make our presentation or put our report together? It's also clearly not stated, but in the UK, cost report is normally done every month. But some projects, some will say, okay, this should be done quarterly. But in Qatar here, we normally present the cost report on a monthly basis. So then I move on to say the distribution and the confidentiality of cost reports. The cost report, it should be agreed between the client. If you're on the consultant side, it should be agreed with your client on who you should send the cost report to. And cost report, it has high level of confidentiality. It should not be disclosed to anyone apart from the client. So that is about the model and other items I have for cost reports. Then I move on to the doing in cost reporting. That is the application. When you applicate, you are trying to apply cost reports on your project. What are you supposed to do? First of all, you have to establish that, yes, there is a budget. There is a budget. And this budget is either the ones that is subject, the one that is, subject is the subject of the construction cost of the construction contract, and the one that is not subject to the construction contract. So the budget is the first thing. Do you have a budget? Has the contract sum has it been agreed? Has the contract been signed? So that budget is very key in our cost reporting. So when project, contracts are being packaged and the contract sum is not yet ascertained, you can't say that, yes, this is an established budget. So the actions here is that in the treatment of a variable cost, do you include it in the cost report? Our question here is yes. The variable cost we have just mentioned now, that is a particular term. Then you have to look at the provisional sum, you have to look at the prime cost sum, you have to look at the day works allowances and the risk allowances. Yes. Then the treatment of variations. This one, we all know variation processes. There must be instruction for contract instruction from the client before you can go ahead and carry out variations. For the anticipated instructions, early warnings, you know how to handle that. Notices to claims, some claims are valid, some claims are not valid. So you need to do an assessment of the notices to claim. Those that are valid, you can estimate cost for those ones. Then we have the drawing revisions. There are some drawings that have been revised, so those ones, you need to know what is compare the drawings to say the issued drawing, the earlier issued drawing, and the current issued drawings, what are the differences, and you attach cost to them. Then the other one is the specification revisions. Specification revisions can lead to variations. If the specification is revised against what is included in the contract, it goes further to add, to the cost, either addition or omission, either ways. Then we have program delays by the client. Just 1 second. Erastus. So program delays by the client. If the program is delayed by the client, it can lead to prolongation costs, which you have to estimate to see how you will include this in the cost report. Then I have treatment of value-added task. Do not add, according to RICS guidance note, do not add VAT to your cost report. This has been advised that we should not add, all our cost reporting our report should be exclusive of VAT. Then treatment of capital allowance. Capital allowance should not be included in cost report. Direct costs, there are some projects that the clients themselves handle, in relation to the current project that you are working on. These direct costs can be reported in cost report. Works that are undertaken by statutory authorities, these works can be included in cost report. Then we have planning costs. All the costs that are, encountered, that have been experienced, that we determine them as planning costs also can be included in the cost report. Okay. Then I go to high level cost reporting. If you are a commercial manager, you are, a senior quantity surveyor, and you are at the level of advising, there is a high level report of cost report that you need to present. So this one, we look at the strategic importance of the cost report, where you can advise the client. This is the time that you have to look at the indices that you have, and say, oh, this is you have to do a lot of cost control, to the point that maybe you have, let's say 12 months in the project, and the cost report you are presenting is maybe the 6th cost report. I discover that you have outstanding works to be completed. So you look at it and say, okay, the outstanding works, the cost of the outstanding works is far ahead the cost that is available to carry out that work. So if you need to carry out value engineering, you need to advise your client. If you need to reduce the scope, you need to advise the client, whatever you need to do, so that the client will have an impression and say, yes, this is the point that we are now, and this is where we are coming from, this is where we are at this point, and this is where we are going. You need to advise your clients. This is the high level level. If you are working with the client directly, or you are a commercial manager, you are in the position to advise, to sit with the client. This is the point that I am talking about now. You need to have cash flow focus. You have to have cash flow reports that you need to show to the client and say, okay, at this point we're supposed to expend this amount, and this is the amount we have expended, and this is the level, this is the way the curve is going. You need to display a curve to show the client that, yes, this is where we are at this point, and this is where we are going. And this presentation, this advising that I'm talking about, it must be a presentation. It must be a one-on-one meeting. It's not something that you do and you send by email. You must prepare this report. You must seek for a meeting with the client where you can show the client all the reports, all whatever you have, indices that you have, you'll be able to demonstrate to the client, advise him on the steps to take as the project proceeds. There's what we call budget holder reporting. The budget holder reporting is what you have to do. The quant surveyors, as we know, we are very powerful in the industry because we are dealing with costs. And costs, as we know, is highly important in every project. So the budget holder, like if you take a building project for a building contract, for instance, you have the structural engineers, at times they over design. So you need to you allocate all those costs, look at the costs, analyze them and say, oh, the problem that I have on this project is on the structural element, is on the architectural element, is on the interior design, is on this, is on that, So you should be able to look at the costs, attach all these costs to all these, appropriate them to the relevant professionals, and sit with them, get their inputs, and look at ways that any aspect of the work can be improved. Then this should be included in the high-level reports that you are going to present to your client. And there's another one we call contractor consultation. After preparing the cost reports and you want to advise the client to discover that the indices, you are going to get the CPI and the SPI, and we'll get to that at the end. The indices you are getting they are not good enough for the project. So the high level report you're supposed to give here, before you do that, you need to request from the client that you need to have a meeting with the contractor. So you have this meeting with the contractor, then you get some input from the contractor, because the contractor knows everything. They'll be able to advise, they'll be able to tell you the problem that they are having in terms of this element of the project, in terms of this aspect, in terms of this. So from that meeting, you'll be able to prepare a report and make it as part of your report to the client. Also, there will be client and budget holder presentation. So this one is part of the presentation that we're talking about. We have all these different presentations that you have to do, but you put all of them into one, and you'll be taking them one after the other. Client and budget holder presentation. So in that one, after getting all these inputs from the designers, the structural engineers, the architects, all the professionals involved in the industry that relates to the project in question, then you should be able to have input for them and be able to put them in the report. The risk allowance management is the same thing. The reporting on loss and expenses, an expense is the same. You have to report on penalty. Are you going to the client going to penalize the contractor or liquidate them as an ascertained damages, as the case may be, depending on your location or depending on the project they are handling or contract you are handling. Then how to treat and report, tender adjustments as well. So all these I've mentioned, I want to recap again. Strategic importance has to do with cost control, it has to do with cost reporting, has to do with cash flow focus reporting, and then we have the second one, which is budget holder reporting, contractor consultation, client and budget holder presentation. Then we have risk allowance management. We have reporting and loss and expense, reporting of liquidated and ascertained damages to penalty. Then how you treat tender adjustment and all that. So this has to do with this. It's very unfortunate. The practical demonstration that I wanted to do, the spreadsheet that I have, the dashboard that I have, is we can't see that. I have a dashboard now to present, to show us how this is being presented. The dashboard, just like we have the car that we drive, and we're always looking at the dashboard to see whether we are overspeeding or we are underspeeding, we are moving too slow, or we're disturbing other people, or we are moving very fast and we're going to be caught up with speed cameras and all that. So this dashboard is a dashboard for the QS on the project. This dashboard that I have, I'm looking at currently, has all the contract trackers, the contract particulars that has to do with the expiry dates of the performance bond, the contractor's all risk insurance, the workman compensation insurance, the equipment insurance, the bond retention bond, all these commercial registrations, authorities, authorization letter, signatory, all these expiry dates, ID, signatory, and all that, advance payment bond. So you will see all this at a go in one sheet. Then you will see also the financial statement, the financial summary that shows the contract sum, the site instructions that are approved, the variation of that, and the site instructions, the anticipated site instructions, the provisional sum adjustment, and all that is necessary. So you now have a focal final account. By the time you add everything together, you now have a focus final account. Then on the same dashboard, you will see key notes of the financial note, key financial notes that you keep, and then do you have revised baseline program? What is the number of the review or the revised number that we have? What are the number of VOs that are still pending to be reviewed? You look at the movement that you have in the period. What is the reason that this movement is going negative or is going positive? So you give the reason, just a summary of the reason that you have this movement between last month, the previous month, and the current month that we're talking about. Then on that same dashboard, you have the focal, the focus final account, you have the accruals, you have the remaining amount for the project, you have the percentage of the cost that you are paid to date, you have the cumulative focus, you have the actual certified, you have the variance. So all this, you can see them on the same dashboard. So on the same dashboard, you have the CPI. We're going into the, I also have the spreadsheet that shows how these site instructions are presented, how the cash flow focus is presented, and the format that they are being presented, and how you are able to show the movement between the previous month and the current month. So I have the spreadsheet that I would have shown you here, but unfortunately, this cannot show us on the screen. So I will go now that after you must have done this, you have your cumulative focus, you have the gross, you have the actual certified, then you have the variance. So you have the variance, then you have the percentage variance. Then we go on to the M value management. The M value management. M value management. So M value management, as we know, has to do with how you are able to give value, the payments that you make on a project, you give it a value that you'll be able to check to know whether you are not overpaying the contractor or you are not underpaying, to see the progress in relation to the amount that you are paying. And the end value management is based on 3 metrics. The 3 metrics that we have, the first one is the planned value. The planned value has to do with the percentage of work that is planned, percentage completed as per plan. Then you have to multiply it by the budget at completion. The budget at completion. So example of this plan value is like to say, okay, you have 100 million, for instance, and the plan is that, okay, if at 50%, you have 50 million, it means that your percentage based on the plan is 50%. Then that is the first metric. The second metric is M value. M value has to do with the percentage completed times the total budget. Percentage that is actually completed times the total budget. Then we go to the last matrix. The last metric is that we have the actual cost. That is the amount that has been spent. The amount spent is the actual cost. So the plan value is PV, and the M value is EV, and the actual cost is AC. So if we go now to the examples I have here, it's very, very unfortunate, but I'm sorry, I don't know. I synchronize this with Zoom a lot, but I don't know, it doesn't work with Meet.Google. So if you have a pen, you can write so that we can do this calculation together. We have an actual cost of 47.6 million. 47.6 million. And we have end value. This 47.6 million, based on what I have, is the actual cost, the amount that is paid on the last certificate, the cumulative amount that is paid to the contractor, 57.6. Then I have the percentage, the end value now is 42%, and I have 126 million for the total, the contract sum. So if I multiply the 42% by 126 million, I have 52.9 million. That is my EV. So AC is 47.6 and EV is equal to 52.9. Then my plan value, because the plan value now, you have to use the number of days. If the number of days for the project is 100 days, and the time you are preparing the cost report, you have spent 50 days. The percentage here is 50%. But based on the example I'm using, the percentage here is 80%. So what I have here is 80 multiplied by 126 million. 126 million is the contract sum. So my plan value is 100.8 million. So we are going to be using this one to calculate our cost performance index, which is CPI. If I say the actual cost is 47.6, the end value is 52.9, and the PV is 100.8. That is 80% times the contract sum. So what it therefore means that our cost performance index, for you to get your cost performance index, you have to divide the end value by the actual cost. The end value must be divided by the actual cost. That is the amount that you multiply the 42% based on what you have paid previously, over the multiplied by the contract amount, you have 52.9%. Then the CPI now is M value divided by the actual cost. So I have 52.9 divided by 47.6. So my CPI is giving me 1.1 to 1.13 thereabouts. So if your CPI is greater than 1, then the project is moving on a good pedestal. The project is moving on the budget. The budget is moving well with the budget. Then we now say it is okay. But if at the end of the day, your CPI is less than 1, it means that there is problem with your payment. Because at the high level, this is what they are going to use to judge your cost report. So your CPI, if it's less than 1, then there is problem with your payment. It's either you are overpaid, in comparison with the work that is happening on site. So what I have here is 1.13. I'm just using a typical project I've worked on in the past years, and this is a real life project, based on the experience I've had. So I have a CPI of 1.13. Then for the schedule performance, there is a problem here. Schedule performance is N value divided by the PV. Our N value, which is 52.9 million, divided by the planned value. The planned value is 100.8 million. What I have here is 0.53. If you can, it's just that you cannot see my screen. What is here is 0.53 in red. This means that, if it's less than 1, it means that there is a big problem here. So the SPI, the Schedule Performance Index, is less than 1. That means the project is not moving according to the schedule. Okay, then there is what we call, again, lastly, what I want to say is, I want to just talk about here now is the cost variance. So our cost variance is for you to just subtract the actual cost from the end value. So the actual cost, you subtract it from the end value. Then if you have a positive number, so our end value here is 52.9 million. Then our AC is 47.6. So I have 55.5 million. It means that I have a positive, cost variance. A positive cost variance means that the project has been over budgeted. And a negative cost variance means that there is cost overrun. That means the project is going high above the budget. But a zero cost variance means that the project is moving as per the budget, is moving on the budget. So I would like to bring the presentation to a stop here. Then if we have any question, then we can go ahead and ask. Thank you very much for this opportunity. And once again, good evening. So I expect if we have any question, this is time for us to interact and put our questions through. Thank you, ladies and gentlemen.
Thank you very much, Mr. Victor, for what you have done for us in the past 1 hour or thereabout. We thank you for giving your time and your resourcefulness to this subject of earned value and practical cost reporting. I'm sure that most of us online have gained 1 or 2 things For some of us, it's refresher. For others, it is new thing, and we can report better now going forward. And in addition, we understand the importance and the implication of our reports, what it's used for, what the client is looking for, and what should be included in our reports. And again, concerning the earned value techniques that have just been described to us, even though we had a challenge of technology that we couldn't share the screen, at least we picked some new terminologies and some new applications in earned value, in actual cost, in planned value, and all that. Some of us might have one or two questions. If you can signify, we can unmute you so that I can ask the questions. And you may also type it in the chat box, and the presenter can pick it up from there and address any question that you might have. So I will pause for now and wait for our questions. Or you might also have contributions. We are open to that. Thank you very much. Someone has asked for the presentation to be shared by email. We will do that. Okay, we have Olumide Mayor. You can, Olumide Mayor, let me unmute you so you can ask them the question. Olumide Mayor. Olumide Mayor, can you unmute yourself and ask the question? Yes, go ahead.
Okay, thank you so much, Mr. Victor. My question is kind of practical. I just want to know the factor to consider and professional ethics or procedure to follow in a situation where you have you're handling more than one project, like 2 or more projects that share the same resources. So while doing the cost report, what are the things to consider? Do you get my question? Like if you have 2 or more projects, let's even say 2 projects, and they share the same resources, maybe they share the same, let's say, management resources, or they share the same sites, the same sites, or maybe they share the same, maybe engineering team. Like some teams are working on 2 separate projects, and you want to do a cost report for both projects. So what are the things to consider, when you have this type of situation?
Yes, Olumide, I think your question is clear enough, but I need to just ask you one question, because I think we had a similar project like that in the past, where we have 2 contracts. So I would like to ask you, is it 2 different contracts? If they have 2 different contracts, they will definitely have separate preliminaries, general items.
Yes, it's 2 separate contracts with 2 separate budgets.
If they have 2 separate budgets, the situation that we have like that before, what happened is that the cost report is put together. The cost report is put together as a report, just one report.
Okay, so it should be one report, not 2 separate reports.
No. What we did before was a separate report. Sorry, it's a separate report, because they have separate contract sum, separate variation orders. When you have 2 contracts, it therefore means that you have separate 2 different contractors. So if you have 2 different contractors, the claims that are coming from the 2 different contractors are different. So the reporting format is different. So you have different project managers, you have different issues, you have different issues, that is specific to that particular contract. So when you have 2 different contracts, you have to prepare 2 separate cost reports.
But in this case, if they have the same project manager, and let's say the same procurement team, the same design team, but different direct labor. So what are the things to consider? Majorly, if they have, let's say there is only one project manager that is managing both projects, and you want to make a cost report that actually, specify on the cost of the human resources?
See, the major question is, are there two contracts? If there are two contracts, they have to be treated differently. If they have two different contracts, two different contract numbers, that means the cost report must be different, irrespective of how the management of the project could be. Do you understand?
Yes, I do.
If they have two different contracts, they have separate contract amount, the cost report must be different.
Okay, thank you, Mr. Victor, for your response. Basically, what we can get from there is that anytime you are reporting on a contract or on a project, what the underlying guidance is that you must, once you look at the contract, once you have two contracts, you have two reports, regardless of how the resources are applied to the different types of the contract. I think there's a comment here. Let me allow Mr. Nuruddin. Can you unmute yourself and give a comment because you raised your hand? You are still on mute. You are on mute. Unmute yourself, please. Mr. Nuruddin, we can't hear you. Mr. Nuruddin, we can't hear you. You are on mute. Okay. We'll go to Mr. Debo Wale Oyinleye. Can you unmute yourself and ask a question, please?
Yeah, I believe unmuted. Can you hear me?
Yes, we can hear you now.
Okay, good. Yeah, I just want the presenter, by the way, let me appreciate the very nice presentation. I really enjoyed it, although I joined late, but I still was able to pick up some things from the presentation. What I want to find out is from your own experience, can you tell us some limitations of this end value management on projects and monitoring or control? Are there limitations to it? Because I think I've come across some school of thoughts that actually emphasize on the limitations of the end value. For example, it seems so much to assume that expenditure is a straight line. In the course of the project, the expenditure is actually done on a straight line basis using the duration of the project, just using it irrespective of how costs will be incurred during the course of the project. Do you have limitations or have you experienced some issues while using the end value to monitor your projects? Thank you.
Yes, I think that is a very good question. If you look at most of the payments that are made during the project execution, these are actual payments, okay, based on what the contractor has done. And if you look at the indices that we just looked at, let me just take my screen once again. If you look at what we just look at now, there are, limitations, because M value is based on the contract sum of the project. So the limitation that is visible here is that at the end of the day, this contract sum that we have, using this percentage in relation to the contract sum may not be what we are going to have at the end of the day. There will be changes. There will be the contract sum can go up, it can come down, but at the same time, we are using the original contract sum in relation to this M value. So there are limitations there, but we use it. It's being used so that the client can have an idea of the movement of the project commercially in terms of the budget. If we don't refer to the contract sum, there is no way, there is no other sum that we can refer to. But the estimate, which is the contract sum, which we have, also have limitations, because a lot of things have been factored. There are some items in the contract sum that may not be executed. There are some of the items in the contract, in the original contract sum, that we could have additional amount that will alter the contract sum that we have. I don't know if I've answered your question. The limitation is only in the contract sum. Thank you.
Okay, let me just add to that and just support Victor in his response. In the first instance, like Victor rightly explained to us earlier on, earned value system, earned value reporting, earned value technique, and cost reporting generally are based on the contract. The contract, in most instances, will tell you that this is how to report, since there is no particular format that has been approved by any known organization. But most contracts will determine and say you report based on earned value, report based on any other type of system that you have. Then what we have seen in most instances in the industry generally is that earned value reporting, and it's most akin to engineering projects rather than the building and construction project. So when you are doing a dam, when you are doing laying cables and fiber optic cables and things like that, or you are doing oil rigs and similar, we have seen in those instances where they have adopted the earned value as against typical building or road projects. Then the basis why we have this comparison in reporting for cost as we report as quantity surveyors and reporting as they report in earned value techniques like by schedulers, planning engineer, is a function of how the project has been described. So you have a situation where you have the project schedule, you have the project program that has been cost loaded, and all the activities have been defined, broken down in the WBS, all the way down to the smallest activity. And all of that can be used in the end value for reporting purposes, and you can report the cost, right? But however, when you have a project where you don't have that level of scheduling, where you don't have that level of impact, and you want to report based on the certificates that you have issued, based on the work done that you have done, based on the variation that you have captured, there's always that debate in the industry that, okay, we can't use end value in this regard, we can't use a normal cost reporting in this regard. But at the end of the day, it's a function of the judgment of the major stakeholders in the project, and it's a function of the type of project, it's a function of the type of contract that determines which is best for the project. And the criticism and the, maybe not criticism per se, but the shortfalls or the limitations that are there are also typical to the type of project and the structure of the project in all. That is just my little contribution. We have Alagwe that has raised his hand. Can we have a response from you? You can unmute yourself and talk, please.
Okay, thank you. Can you hear me?
Yes, we can.
Okay. Mine is not a question. It's just to add to what Mr. Victor has said while responding to the first question from Mr. Olumide Mayor. I remember that, excuse me, please, when we were working on the school project, I was with the consultant then, and we had over and above us then the program management consultant, which was Macy CRS. In our cost reporting then, we had two reports that we usually prepare because we have two contractors. Although these two contractors were handling, one was handling three schools. Each one of them have their budget separately, and the other one was 4. At our level, we were presenting it based on the number of contractors, that is 2 reports. But I noted that each time I visit the PMC office then, they were preparing just a single report because they merged all the reports from all the contractors and consultants under them. So I want to say that I think the way it should be presented will depend on the requirement of the client and the level bringing back the. Okay. So I think it depends on the level from which the QS who is preparing the cost report is operating from. At our level, then we were operating at the level of the consultant. Whereas over and above us, we have another QS who is harmonizing all that we were preparing for presentation to the client. This is what I want to add to it. Thank you.
Okay. Do we have other questions, response? Is there any? And you can, the platform is also available for you to type your questions so we can read it out and the presenter can respond to it. Other people can contribute on the subject of earned value and practical cost reporting. You should understand that what we have learned today, what we have discussed so far, and what Mr. Victor has presented to us is about how we report practically, not just the numbers, not just what we have seen theoretically, but basically what we do every time we are reporting, the things that are important that should be part of our report and how we classify them. Okay, we have a hand up for Mr. Abdullah Abdul Latif. So you can please unmute yourself and ask your question. Mr. Abdullah, you can go ahead, please. Please unmute yourself and ask the question. Mr. Abdullah, can you hear? Can you unmute yourself? Okay. Okay, we have Olumide Mayor. Can you please unmute yourself and ask the question or contribution?
Yeah, hello. Just to be specific, what actually happened on the project is that there is a project manager on the project that is handling 3 projects, and while reporting the wages for him, the question arises that what was the basis of the percentage, because on that it was 30 to 40%. You understand that? So that what was the basis of why do I use 30% for the project manager wage on project A, and 30% for project B, and 40 for project C? So I just wanted to know, what are the professional ethics, or what should I consider if I'm trying to prorate the wages of the project manager that is handling 3 projects with 3 separate budget. Hello, do you understand me, Mr. Victor, or maybe anybody in the house?
Okay, go ahead. You're talking about for your general items or the preliminary items you're talking about?
It's for the general items that fall under the wages on the salary of the project manager, because the project manager cannot be earning 100% on the 3 projects that is handling. They want to prorate the wages of the project salary of the wages of the project manager on all the 3 projects that is handling.
You need to tell us the type of project, because why should a project manager be handling 3 projects? Is it 3 separate contracts or one? I don't understand the project. So just clarify on that so that we can have an understanding, please.
Yeah, the project is actually it's okay. What happened is, they started the project, its original project, and they have another project, and they want him to also manage that project until the first one is completed. So it got to a stage that while the first project is at, I think it's about 80% complete, you also have a new project, while the second one, I think, was around 30% complete. So he's actually managing 3, is the project manager for 3 separate projects.
With 3 different contracts?
With 3 different contracts. Okay.
So, when all these superintendents, attendances and all that, see, preliminaries are usually, how you pay preliminaries, they are usually being set up from the beginning of the project. So If you set it up, you set your preliminaries out, the items that are for mobilization, the items that are for time-related, and the ones that are terminal. Once you do that clearly, and it's been agreed with the contractor, every month you know the percentage you are going to pay for the project manager. So since you are having this type of issue, that means is the project manager aspect, you need to go back to what has been prepared initially in the project. Then after you must have discovered that, then you now know what you will use for the other two projects. It has to be established from the beginning to say, okay, this is the amount that will be allocated for the superintendent, and because the superintendent amount is on project is a lump sum amount. So you need to divide them, and you need to really allocate them from the beginning, know their attendance, what they are going to do, and at what point, what is the duration of the project. So you prorata them accordingly. Then you now say, okay, every month, this is the amount you will pay. So what you will pay now, from there, you now know the percentage that you are going to pay the project manager. So you look at the other contract and say, okay, who was the project manager of the other two projects before? Are the project managers still available on the project? If they are not there, then you'll be able to say, okay, if this project manager is taking over the job, how much has been paid previously for the project manager, and how much are you supposed to be paid? So you need to look at, if they don't have any set, the preliminaries have not been clearly defined, clearly separated, for you to pay, then you have to do that. And if you don't do that, you have to justify to say how much is supposed to go to the project manager. So it's not just, I don't know how to put it now. You don't just go and just allocate the percentage based on, visual, the way you perceive it. It's not by perception that you say project manager must get 30%, this one must get this percent. No, it's not done that way. You have to look at the breakdown of the cost of the superintendent, then you now allocate them accordingly before you now say the project manager is supposed to get this. Otherwise, if you are being called to question, you will not be able to answer that question.
Oh, thank you very much, sir.
Thank you.
Okay, do we have other questions and contributions concerning what we have learned? Any hands raised? I think Mr. Abdul-Latif raised his hand before. I don't know if he's still available to ask the same question or contribution.
Hello, may I speak now?
Oh, go ahead, please.
Yes, I have observed that, good evening, everybody. I have observed that all the questioners are asking from the perspective of a contractor, and the presenter has presented from the perspective of the client or a client employee or consultant. Let me just say that the end value management is most suitable for the contractor. So, and that is why when he was talking about end value, he was talking about cost variance. He was saying that if it is positive, then that means there is an overspend. Meanwhile, in the contractor's perspective, from the contractor's perspective, if the cost variance is positive, that means there is profit. That means the enterprise is profitable. So, that makes the difference. So the first question was talking about how to make the end value analysis, or how to write the cost report about different projects being managed by the same project team. I would say the best practice is to separate the reports, and that is simple because there is a basis for each. If there was no basis, there should be assumptions that are clearly made, because that leads to the second question. The second questioner was also talking about somebody asking him what the basis was for him of rationing those costs. So there should be some assumptions that are made, and if it is possible to know the people that have priced the documents, that have priced the projects, maybe they will be useful in getting those prices. Getting those assumptions, or maybe the facts that are necessary to properly prepare the reports. So you don't prepare reports, cost reports, or end value analysis based. Theoretically, the practical thing is to know the basis of the prices or the basis of the costs. If you don't have, you ask. Just like you don't make estimations without basis, you do not make reports without basis too. So I think that is my contribution to the discussion. Thank you.
All right. Thank you very much for the contribution. Do we have others online? Any hands raised? I can just remind us that we can type our questions in the chat box at the bottom right of your screen. Okay,
Hello.
Mr. Abdullah.
Yeah, I hope you can hear me now.
Yes, we can. Please go ahead.
Yeah, thank you very much. Good evening. Mr. Victor, that's a good job you've done there. Thank you very much. Sorry, at the beginning of the presentation, I jotted something down which I would like to ask. You mentioned that planning costs should be part of what we put in the cost reporting. I wanted to know, what do you mean by this planning cost? That's my question. Planning cost. When you are listing the constituent, the items that should be included in the cost reporting to the client, you made mention of a planning cost amongst others. So I need some explanation on this. Thank you.
Okay, generally, let me just make this this note. Cost reports. When we are preparing cost reports, we should everything that we do, the format and what should be included in the cost reports must be, first of all, agreed with the client. This is a strong note because there are some information that the client may not want to see in the cost reports. What I have here is that the planning consent granted for the construction may include requirements for the client to make payments that are outwith with the construction contract. The conservator should seek instruction from the client as to whether this cost should be reported in the cost reports. There are some planning costs when the project is being awarded to the contractor. There are some charges that will come from, if you are talking about infrastructure, there are some levies here and there that the law may require that this has to be paid for the construction of the project. Some of these costs will have to be included in the cost report. The client planning consent, this is, in Qatar here, it may not be applicable because most of the permits that the contractor go to collect, to pay, everything is being put on the side of the contractor. Contractor pay for the permits. The contractor go after everything with the assistance of the client or the consultant. They support them. But in other areas, places like UK, planning costs, which, consent that is being granted for construction by the government, the client has to pay. This cost has to pay. And when reporting, this has to be included. So if it's applicable in your own location, you have to include this planning cost that is being borne by the client. Otherwise, it is not necessary. Okay? Do you understand? This is for the like here we have Ministry of Urban and Urban Planning. So if you want to start a project, the client will have to pay some certain amount to the ministry. So these costs must be included in the cost report. But in Qatar, I don't believe it is applicable because all the costs, although it's paid by the client indirectly, but the contractor will first of all pay this cost. So if they are exclusive of, if they are separate from every other thing, it must be clearly shown that this cost is for planning. It must be shown in the cost report.
Thank you very much. It's clear now.
Okay, thank you.
Okay, thank you very much, Mr. Victor, for the response. and for the guidance. Do we have other questions, responses from people on the platform? We have a couple of minutes to spare. Do we have contributions from us concerning what we have been discussing so far on practical cost reporting and end value management, end value techniques, end value reporting? Any contributions, comments?
In my presentation, I mentioned that, you know, tax should not be included in the cost report. I'd like to ask us, we are all quantity surveyors, we are all experienced people, and the capital allowance should not be included. I want to ask that why are all these costs excluded from the cost report? I don't know if anybody can answer that, since we still have little time to spend.
Anybody that's willing to answer that can raise up their hand so we can have it in order, or you can type your response in the chat screen concerning why VAT or other taxes should be excluded from the cost report and capital allowances. Any response? Maybe Mr. Victor, you will help us.
You will be the one to help us. You will be the one to help us. You will be the one to help us, because I know you have the answer.
I may not have the answer, but I just have a response from anybody on the platform.
Yeah, you should be the one to help us, because taxes are not supposed to be reported, you know, so why?
Okay, let me just, Mr. Onyile, are you? Tax is fluid, subject to change. Okay, somebody wrote here that tax is fluid and is subject to change with time. Okay, that's a good response. We have tax is fluid. Mr. Jacob Kwame says tax is fluid and subject to change with time. That's the response. But let me attempt the part of the tax, and before I go to the capital allowances. In the first instance, tax is based on law of reporting within any jurisdiction, right? What is reported, what is taxable, what is not taxable is based on the law of the land at every point in time. In addition, tax also based on organizational policies and reporting requirements. So there's a contracting organization even though the work is being done in a particular region, the law of that land applies to everything about tax. The contracting organization is working in that region, reporting its own tax, but internally they have their own internal accounting principle and policies that might be different from that of the client and different to the next person. And how that tax is reported on their books is different. What is taken in terms of depreciation, amortization, and all of that, and you know what you see in those numbers is different. That is another part. Another thing again that impacts how you will report tax in your cost report is that you do a project over time. The resources that are inside that project are having different values over time. For example, head office overheads, how it is treated in their books, and how it's treated, on the project. How all of those things impact what is reported for the month that is under consideration. So when you see all of these variables and external factors, external dependencies that you cannot control, that are not directly related to the project, and you want to use, and you now want to report those things in a form of tax, the actual net effect of everything that I've just explained now, the law, the jurisdiction, the accounting principle, the issue of depreciation and amortization, all of that put together give a net effect on the impact of tax. And you want to report it in a month-by-month cost report or quarter-by-quarter cost report. There is likelihood that there will be misrepresentations, and there's likelihood that the reporting will not be true to the situation of the project. So it's best to exclude things that are not, even though we call them indirect costs and direct costs, but these are not directly, if I'm allowed to use that kind of word, related to the project, because there are too many external dependencies, too many external variables that are not related to the project that can misguide what you are reporting. So that is my take on reporting on the tax. I hope everybody picked one or two things. And Mr. Victor, you can confirm if I've said the correct thing.
You are very much correct. You are in the financial industry, and you know everything about tax very well. Thank you for that great insight. And that has been because of the variables. The variables attached to cost reports to tax, the changes and all that. If you start to deal with that one in the cost reports, it will make the report confusing and complicated. When I started by saying that cost reports should be as simple as possible, should be easy to understand. So when you start bringing tax in, it will cause more problems. So am I allowed to ask more questions? Do we still have time just for us to interact and all that?
We still have some few minutes, so before we end, in another 10-15 minutes, we can call it a day.
Okay. So
you can still ask. There are people on the platform, I'm sure, that are willing to respond to the question, so we can be interactive and we can learn one or two things.
So as a QS, if you discover that you have, in a particular cost report, to discover that you have overpaid the contractor, what should you do? What should we do? If your cost report shows that this is what has been achieved and what has been paid is more, because once you are submitting a cost report, you are presenting yourself, what you've been paying over the months. You are showcasing your professionalism in total. You're showcasing, how you're monitoring all the variations, everything, Then at the end of the day, the dashboard shows that you have overpaid. What are you going to do? Thank you.
Can we have raised hands, please? Okay, we have Mr. Adebowale again. Please unmute yourself and answer the question. Okay.
All right, thank you very much. Okay, yeah. I think one of the first things that a consultant or a professional on a project like that needs to do is to, first of all, identify why it is so. Because the question that your client will ask you is why. And then from understanding why, then you should be able to answer for yourself and the way you are going to present to the client, now your client, how come it happened? You must be able to answer. If probably it's an error on your part, then you need to know how you are going to present it. But if actually it's a peculiar thing with that kind of project, probably there was an arrangement that was done on the project, maybe the contractor was paid up front for some things and all that. If that was the case, then you can easily explain. But I think the key thing is to first of all understand why, and then how it can be resolved. Those two things you need to prepare when you are going to submit your report. Thank you.
Thank you, Mr. Adebowale. Any further response? There was a Rotimi Joseph. Rotimi Joseph, you still want to respond?
Yes. Just to add to what Mr. Adewale just said. The other thing that we need to do is, as a professional, you have to take responsibility. Because one of the things that we can do in that situation is to start looking for who to blame. So we should be able to take responsibility by actually letting the client know that actually I made mistake on the last report I submitted. There was mistake on it, but thank God it's not the final account, because if it happens to be final account, it might be difficult. So, but with that, since it's something that you can actually retrace your step back and next valuation in your cost report, that can be adjusted, but it's as part of the professional ethics we need to come clean for the client and say, well, I made mistake on this, and this is it, but this is how we're going to do it to rectify the problem.
Thank you very much for that response. It's very deep and it's enlightening for most of us, especially we that you have to face the client and make all of this report. And for those that are just coming up in the industry, this is very important to you. Those that will be sitting for the RICS, APC, or the NIQS, or all the professional qualifications, as the case may be. Ethics is very important. This is an opportunity to learn. There's a practical application of the core principles of ethics in the profession. Ability and the willingness to come clean, ability and the willingness and the openness to take responsibility for your actions and not to do the blame game. Because in this industry, we see people doing the blame game. I mean, architects will blame engineer will blame the soil. It happens like that every now and again. But really, we must take responsibility for our errors. No human is perfect. And according to what Mr. Adebowale said, you must first identify where the error has come from, trace it, own up to the reason why the error occurred, and own up to your responsibility. It's a core part of the ethics of the profession, and after that, that can be resolved. And what I just want to add to it is that generally most standard forms of contracts have provisions for you to make corrections in your certificates, right? So what you are reporting is what has transpired on the project, the payments you have made, the physical progress that you have reported, and all of that as against the payment. So when you have made mistake on the payment and you have been able to trace where the errors came from and things like that, if it's truly an error, it's possible that it's not an error. Just like Mr. Adebowale said, that it could have been a plan or a structure, an agreement that some things will be paid in a particular way. So it's an overpayment, but it's not an error. But if it's truly an error, the contract, most standard forms of contracts have given provisions for the engineer to recertify and correct those errors. Can I have response from Mr. Victor? Thank you.
Yes, I think the question has been well answered. Ethics come into play. What Rotimi was saying. You need to agree. You need to agree that, okay, like what Mr. Adebowale said. You have to first of all ask the why. Why is it that this has to happen? Because that is a question. Where did it happen? Why did it happen? So you need to check yourself, ask yourself that question, trace it, and you know how to handle it. You have to prepare yourself, prepare your answer accordingly. Rotimi has said that, okay, you have to own up to it. I discovered that, okay, for most contractor QS that I deal with, they like covering up. They will not like to open up to you where the mistake is. But as a professional, and the professional ethics, RICS has it that we need to agree. We need to own up to it and say, yes, it is my fault. And why did it happen? Why? They want to ask, okay, it's your fault. Why did it happen? How are we sure it's not going to happen again? So you need to give a statement to say it happens because this happened and it will not happen again. So how will it not happen? What made it happen? Why did it happen? Where did you get it wrong? Why did you miss this figure? Were you under pressure? You cannot work under pressure. So there are so many high-level questions that will come. So you need to prepare yourself to ensure that you display integrity. Integrity is the key, but most times people look at their job, security and all that and begin to hide out. As QS, they look at us with integrity. Everything is in our hands. The contract is in our hands. The figures are in our hands. So we are the ones that are supposed to put everything clearly so that they can understand. Where you have problem, you have to say, this is where I have problem. And you have to give a statement of confidence that this will not reoccur again. I think that has been dealt with quite very well. So another thing I've discovered, one thing I've discovered is the risk allowance. Quantity surveyors, we neglect risk allowances a lot. We don't give time to it. Sometimes we leave risk allowances to maybe safety. Safety risk is an aspect of the project, but then the risk to the project in terms of cost, commercial aspect is very key. You know, if you go to the risk register, what I mentioned is that our cost report must have risk register. So that risk register must have a value. We must look at it and say, there are some risk, you know, we neglect risk register a lot, but some of those risk register, if we look at them from the various professionals in the project, some of them we can put figure to them and say, this is going to be a lot of, it's going to be a cost to us. Project we're working on, discover big cavity, you know, see hole, you know, in the ground that is not expected, you know. So some of these things is cost. How are you going to mitigate that? You're going to change different levels, you know, or based on the excavation you are doing, you're going to do a lot of changes, you know, but all these things will become, you know, a variation at the end of the day. So we should spend time to look at the risk register, analyze them. We can even maybe cost risk meeting. We can schedule risk meeting to call all the professionals to the table. Let them tell us what is the implication of what they have put down in the risk register. Because you see, the construction professionals, they go to the risk register, they put all kinds of risk there. You know, some will come up with, it's going to be a very high risk, some moderate, some very low. So we have to prioritize the risk, look at the ones that will add costs to the project, and we'll be able to estimate so that we can include this cost in our cost report. Don't neglect risk register. That is the point I just want to emphasize here. Thank you so much.
Okay, I just remember that when I tried to respond to the question on tax and capital allowance, I only mentioned and discussed tax. I didn't mention the part of the capital allowance. But basically, it is about the same thing that you're reporting. Capital allowance in the first instance is what you use to just adjust your tax deductibles and things like that. And because all of this tax and capital allowance are more about the entity that is carrying out the work and are dependent on the jurisdiction, the law, and all of those kind of things, they are not particularly they are not particular about the project. They are more about the entities and so many external variables. The same also covers. So that's why you won't want to be reporting capital allowance of the contracting organization in your cost report. And if you want to talk about capital allowance, the question you want to ask yourself is, are you reporting the capital allowance of the contractor, or is it the capital allowance of the client? Is it the capital allowance of the project if it's a JV? And to what extent does it impact for that period that you are reporting? Is it the first month? Are you spreading the cost over 3 months, over 1 year, over the entire 4-year period? You know, there are so many things, and for this reason, there's even no basis for you to put it. There's no structured or guidance that you can adopt and say, this is why I'm including capital allowance in my report. It's going to confuse you reporting it, and it's going to confuse the client that wants to take information from there to use it in future or at any point in time from what you have reported. So that's just additional response on capital.
Yeah, based on this additional response, you know, we need to look at it again. Who benefits from the capital allowance, client or contractor? So that is who is the beneficiary of capital allowance?
Client, of course.
Any other response from us, questions, so that we can close?
Right.
Mr. Rotimi?
I'm just saying that it's client that benefit from capital allowance.
Yes, thank you. Thank you. Okay, client. Okay. All right. In the absence of none, we say a very big thank you to Mr. Victor for taking our time to prepare this presentation on practical cost reporting and end value analysis, end value assessment on project. I'm sure that most of us that have been here, we have learned a couple of things that will benefit us in writing of our reports and in our profession generally. Once again, we say a very big thank you to Mr. Victor. And as a recap, Mr. Victor has discussed extensively what we should have in our cost report. He has described to us the importance of the cost report. He has described to us the application of the cost report, how it is used on our project and how it is used generally in the industry. And he also went to the extent of describing the earned value techniques, where he talked to us about the earned value, the EV, the actual cost, the planned value, and the ratios, the indicators that help us to monitor and understand the position of our project. If I'll use the words and his actual description, he said it's like a dashboard. When you are driving a car, you can see where your fuel level is, you can see your speed, you can see your odometer, and that's exactly what these indicators in end value techniques show us in cost reporting or in end value management for reporting on project, where he mentioned things about the ratio, the SPI, the CPI, the cost variance, and things like that. So we thank him very much. It's a recap for what we have learned today, and we hope that we'll be able to apply this going forward in our professional career and in our daily lives as professional quantity surveyors, engineers, cost managers, planning engineer, project control consultant, project control managers, and all. So once again, I say thank you all to the participants. Thank you all for the attendees for coming on this platform. We invited you and you shared your time with us to attend this program or this webinar. Thank you, and we hope to see you again in future as we intend to make this a regular platform for us to discuss and share professional experience in the practice of quantity surveying and allied practice. Thank you, and have a blessed day.
Thank you. Thank you very much.
Thank you.
Thank you very much. We really appreciate it.
Yeah.
Bye-bye.
Bye-bye. See you.
Yes.
Thank you all. Thank you all for your time.
Mr. Jubril, good evening. How are you?